In the world of economics, money is supposed to act a bit like water. It should flow from where it's abundant to where it's scarce, seeking out the highest ground. So, capital, in theory, should rush into poorer countries. After all, that's where labor is plentiful, resources are cheap, and the potential for profit seems vast. And yet, our world doesn't follow this simple logic. Despite the promise of higher returns in developing nations, investment overwhelmingly stays within the club of wealthy economies. This strange contradiction is called the Lucas paradox. It's named after the economist Robert Lucas, who in 1990 asked a deceptively simple question. If returns are so much higher in poor countries, why doesn't capital flow there? This paradox cuts right to the heart of economic rationality. It shows us that the global economy isn't just run by neat equations, but by something far more human: trust, institutions, and the long shadow of history. According to standard neoclassical growth theory, capital should always move to where its marginal productivity is greatest. Think about it. In rich countries, where factories are packed with machines and infrastructure is everywhere, adding one more piece of equipment doesn't do much. The returns are small, but in a poor country, where capital is scarce, that same machine could be revolutionary. Imagine a factory worker in a developing nation with only basic tools. Giving them a single modern machine could multiply their output, creating enormous opportunity for an investor. But reality paints a very different picture. Trillions of dollars in global savings just circulate among already wealthy economies. Money flows from the United States to Europe, from Japan to South Korea, instead of flooding into Africa, South Asia, or Latin America. This completely defies the fundamental principle that capital seeks the highest return. Lucas's question blew open a massive rift between economic theory and the real world. Let's rewind to the years after World War II. The world was entering a new era of economic reconstruction. Big ideas like the Bretton Woods system, the Marshall Plan, and later the rise of global financial markets were all built on the belief that capital could supercharge development. Economists dreamed of a world where investment would bridge the gap between rich and poor. They imagined infrastructure, education, and industry blooming across the globe, all financed by international capital. But by the 1980s and 90s, the evidence told a different story. Capital wasn't flooding into the poorest regions. In fact, many developing nations were facing capital flight. Their own wealth was leaving for safer havens abroad. The Lucas paradox perfectly captured this unsettling pattern. Poverty seemed to repel investment, even when the potential for profit looked sky high. So, what's really going on? The first major piece of the puzzle is institutions, the rules, laws, and norms that govern an economy. Capital is allergic to uncertainty. Investors don't just care about the potential return on their money, they care about reliability. Can contracts be enforced? Are property rights secure? Will the government be stable tomorrow? In places where the rule of law is weak or corruption is rampant, the risk of having your entire investment stolen or nationalized can easily outweigh any potential gains. A 20% return means absolutely nothing if there's a 50% chance you'll lose everything. This is why we see capital often flowing uphill from poorer nations to richer ones, often in the form of super-safe investments like U.S. Treasury bonds. It's not that the returns are better in rich countries, it's that the risk is lower. And so, the paradox stops being a mathematical riddle and becomes a moral geography of trust. Capital follows confidence, not just need. Beyond weak institutions, there's another major barrier: information asymmetry. An investor sitting in an office in New York or London might know very little about the real conditions of a factory in Lagos or Dhaka. The lack of transparent data, credible local partners, and enforceable contracts makes these distant markets feel opaque and dangerous. This incomplete knowledge breeds fear. To compensate for the unknown risks, investors demand extremely high-risk premiums. This makes it more expensive for businesses and governments in developing nations to borrow money, creating a cruel feedback loop. The less a country is trusted, the more it has to pay to earn that trust. Global finance ends up rewarding familiarity over pure opportunity. Capital, just like human attention, tends to cluster where it already feels safe. The paradox also exposes the raw power dynamics of the global system. The movement of capital isn't just an economic act, it's deeply political. Large institutional investors like pension funds and insurance companies are bound by strict regulations, credit ratings, and geopolitical alliances that limit where they can put their money. A government bond from Germany is automatically classified as safe, while one from Nigeria is seen as risky, almost regardless of its actual yield. Even emerging economies that throw their doors open to foreign investment face deep skepticism unless they conform to the established norms of governance and monetary policy set by the world as economic powers. In this sense, financial trust is really just an extension of the existing political order. Lucas, his insight showed that any economic model that ignores these power structures is mistaking the map for the actual terrain. But this isn't a permanent state of affairs. Let's look at China. Its incredible transformation since the 1980s shows just how quickly perceptions can change. Once considered a no-go zone for foreign investors, China methodically built up legal frameworks, created special export zones, and invested massively in infrastructure. These actions gradually earned the country credibility. Capital followed that newfound confidence, not instantly, but as a direct result of a visible, long-term commitment to stability and reform. Africa's story is more complex. Despite having vast mineral wealth and the world's youngest population, much of the continent remains chronically underinvested. But look closer, and you'll see the same pattern. In countries where governance has improved, like Botswana, Rwanda, or Ghana, investment follows. Where instability and corruption persist, capital flees. These examples confirm that the Lucas paradox isn't an iron law of nature. It's conditional. Capital isn't blind to poverty. It's blind to uncertainty. Then, in the early 2000s, the paradox got even stranger. Economists started noticing that developing countries, especially in Asia, were accumulating massive amounts of foreign reserves and investing them back into Western assets. In effect, poor countries were lending money to rich ones. They were buying U.S. government bonds instead of using their own savings to build roads, schools, and hospitals at home. This phenomenon, dubbed the global savings glut, made the paradox feel almost absurd. Why on earth would the world's poor nations be funding the richest? The answer, once again, was trust, or rather, a lack of it in the global system. For many emerging economies that had been burned by financial crises in the past, holding safe assets in developed countries was a form of insurance, a rational act of self-protection against future currency collapses and political shocks. The paradox had evolved. Capital doesn't just flow to where it's most productive, but to where it feels most secure. Perhaps it's best to see capital as something more than just money. It's a form of belief, a social trust extended across space and time. Like water, it seeks not just the lowest point, but the smoothest, most predictable path. Where it encounters the rocks of corruption or the turbulence of instability, it diverts its course. But where it finds the clear, man-made channels of law and credibility, it flows freely. The Lucas paradox reminds us that the world economy is built as much on human psychology as it is on arithmetic. The famous invisible hand of the market is guided by a host of invisible fears and biases. In this light, the great challenge of development isn't just a lack of capital, but a lack of confidence. When societies successfully build institutions that can convert uncertainty into trust, money will start to behave as the economic theories predict. The Lucas paradox endures because it marks the boundary where clean economic models collide with messy reality. Capital doesn't follow formulas, it follows faith. The poorest countries can't attract investment simply by offering high returns. They must offer something far more valuable: stability, transparency, and trust. In the end, the paradox holds up a mirror to our global civilization. The true wealth of nations lies not just in their resources or their labor, but in the invisible fabric of reliability they weave. When trust finally becomes the world's most valued currency, perhaps then, and only then, will capital finally flow downhill. Thanks for watching. If you found this exploration interesting, don't forget to like, subscribe, and hit the bell for more deep dives into the ideas that shape our world.